International Association for Business Economics. And we are very grateful for that engagement. So because of that, we are very pleased to be presenting him today with the Adam Smith Award. The Adam Smith Award is NABE's highest honor, and it was named for the 18th century Scottish philosopher and economist whose ideas about economics led to the growth of modern capitalism, and this award has been given annually by NABE since 1982. And it is essentially, as one of my colleagues said to me, this is our Hall of Fame. Past recipients include several Fed presidents and prestigious economists across the spectrum, including Janet Yellen and Ben Bernanke, as well as Arthur Laffer, Susan Athey, and going a little bit further back, William Poole from the Federal Reserve Bank of St. Louis, and Lawrence Klein, who won the award in 2004. We are very pleased today to be awarding this honor to Jerome Powell. Jerome Powell's exemplary leadership as chair of the Federal Reserve, especially in navigating the complexities of monetary policy during challenging times, has had a profound and lasting impact on both the U.S. economy and the global financial system. Under his stewardship, the Federal Reserve has effectively managed unprecedented economic challenges, including the COVID-19 pandemic, by taking a thoughtful and data-driven approach to monetary policy setting. His decisive actions to support economic recovery, promote financial stability, and ensure a resilient financial system have demonstrated an unwavering commitment to U.S. economic growth and well-being. The strength of his leadership has also earned him the respect of policymakers, economists, and business leaders worldwide. His work, particularly in the areas of monetary policy, financial regulation, and economic resilience, absolutely align with the ideals of the Adam Smith Award. He has consistently applied foundational economic principles to address real-world challenges, upholding the Federal Reserve's high standards of sound economic management and transparent policymaking in the process. So with that, I am very pleased to welcome to the stage Chair Jerome Powell. Thank you.
Thank you. Here we go. Thank you very much. You got a camera somewhere?
I thought we did, but maybe not.
There we go. We don't have a camera. There we go. Thank you. Thank you so much.
Yeah, what's going on, guys? Okay.
Thank you,
he's
Emily.
About to speak soon, but
and
so
thanks
far
to the
we already
National
got
Association
headlines
for
that
Business
did come out.
Economics for the Adam Smith Award.
But let's
It,
listen
for
to
me,
what he
is
has to say.
an unexpected honor just to be mentioned alongside many of your past recipients, including particularly my predecessors, Janet Yellen and Ben Bernanke. So thank you very much for this recognition. I will say on a more personal note, I have greatly enjoyed my regular visits to your annual meeting and your conferences. It's really been my favorite venue all these years. It's a place. This is a place where we can talk about economic issues and not worry that someone's eyes might glaze over.
We do have headlines coming out. Comments are dovish.
I also appreciate the warm welcome I've always received here. And putting Fed staff aside for a minute, I can't think of a more lovable group of econ nerds anywhere.
Just muted so far. All right, so like right here, it said recent data pointed a low to higher, right? So he's out here, he's confirming that downside risk to the U.S. job market has risen. So far, this is going to be a dovish reaction. We're going to see weaker dollar, stronger equities. So it's definitely dovish what he's saying
And
so
why?
far. But
with that in mind, I hope to enhance understanding of one of the more arcane and technical aspects of monetary policy.
But overall, it is dovish.
Balance sheet.
Expect weaker
My colleague
dollar,
recently compared this topic to a trip
equities
to the
is what's
dentist.
coming from his comments right now.
I found that comparison somewhat unfair to dentists.
Let me see if there's another one.
So today I'll discuss the essential role that our balance sheet played during the pandemic, along with some lessons learned. I'll then review our ample reserves implementation framework and the progress we've made toward normalizing the size of our balance sheet. And I'll conclude with some brief remarks on the economic outlook.
Because so far he is dovish.
One of the primary purposes of a central bank is to provide the monetary foundation for the financial system.
So it's probably going to be supported for gold too.
This foundation is made of central bank liabilities. On the Fed's balance sheet, the liability side of the ledger totaled $6.5 trillion as of October 8, and three categories account for crediting the reserve accounts of the banks involved in the transaction with the seller. This process effectively transforms securities held by the public into reserves.
Yeah, so far, if you're just joining, Powell is dovish. So this is what's we're going to see the yields most likely push lower. We're going to probably see the dollar push a little lower. Equities is going to be higher. That's what I'm expecting to happen. But he's still speaking. But so far, we got dovish comments coming in from him. All right, so we can just still listen to what he has to say. If you guys have questions, don't hesitate to ask. But so far, I like the dovish reaction, but he's still speaking. So it's either wait till he finish. But him being dovish is not new, just to give you guys an example.
Provide critical support to markets, and were
so Feds could start QE in the coming months. Definitely more dovish than expected.
In July 2020,
it's definitely something to focus on.
Loans from these facilities totaled just over $200 billion. Most of these loans were quickly unwound as conditions stabilized. At the same time, the market for U.S. Treasury securities, normally the deepest and most liquid market in the world, and the bedrock of the global financial system, was under extraordinary pressure and on the verge of collapse. We used large-scale purchases of securities to restore functionality to the Treasury market. Faced with unprecedented market dysfunction, the Fed purchased Treasury and agency securities at an extraordinary pace in March and April of 2020. These purchases supported the flow of credit to households and businesses and fostered more accommodative financial conditions to support the recovery of the economy when it ultimately came. This source of policy accommodation was particularly important as we had already lowered the federal funds rate close to zero and expected that it would remain there for some time. By June 2020, we slowed our purchase pace to a still substantial $120 billion per month. And in December of 2020, as the economic outlook remained highly uncertain, the FOMC said that we expected to maintain that pace of purchases until substantial further progress has been made toward the committee's maximum employment and price stability goals. That guidance provided assurance that the Fed would not prematurely withdraw support while the economic recovery remained fragile amid unprecedented conditions. And we maintained that pace of asset purchases through October 2021. By then, it had become apparent that elevated inflation was not likely to go away without a strong monetary response. At our meeting in November 2021, we announced a phase-out of our purchases, and at our next meeting in December, we doubled the pace of that taper and said that asset purchases would conclude by mid-March of 2022. Over the entire period of purchases, our securities holdings increased by $4.6 trillion. So, a number of observers have raised questions, fairly enough, about the size and composition of asset purchases during the pandemic recovery. Throughout 2020 and 21, the economy continued to face significant challenges as successive waves of COVID caused widespread disruption and loss. During that tumultuous period, we continued to purchase in order to avoid a sharp, unwelcome tightening of financial conditions at a time when the economy still appeared to be highly vulnerable. Our thinking was informed by recent episodes in which signals about reducing the balance sheet had triggered significant tightening in financial conditions, and we were thinking of the events of December 2018 as well as the 2013 taper tantrum. Regarding the composition of our purchases, some have questioned the inclusion of agency MBS purchases given the strong housing market during the pandemic recovery. Outside of purchases aimed specifically at market functioning, MBS purchases are primarily intended, like our purchases of Treasury securities, to ease broader financial conditions when the policy rate is constrained by the effective lower bound. The extent to which these MBS purchases disproportionately affected housing market conditions during that period is challenging to determine. Many factors affect the mortgage market, and many factors beyond the mortgage market affect supply and demand in the broader housing market. With the clarity of hindsight, we could have, and perhaps should have, stopped asset purchases sooner. Our real-time decisions were intended to serve as insurance against downside risks. We knew that we could unwind purchases relatively quickly once we ended them, which is exactly what we did. Research and experience tell us that asset purchases affect the economy through expectations regarding the future size and duration of our balance sheet, so that when we announced our taper, market participants began pricing in its effects, pulling forward the tightening in financial conditions. Stopping sooner could have made some difference, but not likely enough to fundamentally alter the trajectory of the economy. Nonetheless, our experience since 2020 does suggest that we can be more nimble in our use of the balance sheet and more confident that our communications will foster appropriate expectations among market participants, given their growing experience with these tools. Some have also argued that we could have better explained the purpose of asset purchases in real time. There's always room for improved communication, but I believe our statements were reasonably clear about our objectives, which were to support and then sustain smooth market functioning and to help foster accommodative financial conditions. Over time, the relative importance of those objectives evolved with economic conditions, but the objectives were never in conflict. So at the time, this issue appeared to be a distinction without much of a difference. That's not always the case, of course. For example, the March 2023 banking stress led to a sizable increase in our balance sheet through lending operations. We clearly differentiated these financial stability operations from our monetary policy stance. Indeed, we continue to raise the policy rate through that time.
And the yields push lower, it should support gold.
Turning to my second topic, pardon me. Our ample reserves regime has proven highly effective, delivering good control of our policy rate across a wide range of challenging economic conditions, while promoting financial stability and supporting a resilient payment system. In this framework, an ample supply of reserves ensures adequate liquidity in the banking system, and control of our policy rate is achieved through the setting of our administered rates, interest on reserve balances, and the overnight repurchase rate. Reverse repo rate, rather. This approach allows us to maintain rate control independently of the size of our balance sheet. And that's important given large unpredictable swings in liquidity demand from the private sector and significant fluctuations in the autonomous factors affecting reserve supply, such as the TGA. This framework has proved resilient whether the balance sheet is shrinking or growing. Since June 2022, we've reduced the size of our balance sheet by $2.2 trillion, from 35% to just under 22% of GDP, while maintaining effective interest rate control. Our long-stated plan is to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserves conditions. We may approach that point in coming months,
Sergio,
and we are closely monitoring a wide range of indicators to inform this decision.
You don't even want to.
Some signs have begun to emerge that liquidity conditions are gradually tightening.
So far, he's already confirmed
repo rates, along
everything
with more
we
noticeable
expect
from
a dovish reaction.
Dates.
So that's why equities is
pushing
pushing lower, equities is pushing higher, dollars lower. He's confirming that the labor markets is weakening. He's confirming that we're still going to be in that dovish pause policy. So overall still dovish. He's saying the labor markets is weakening. So this is why this is given the market's expectations for cuts to continue.
Normalizing the size of our balance sheet does not mean going back to the balance sheet we had before the pandemic. In the longer run, the size of our balance sheet is determined by the public's demand for our
Dylan, I think QE, you say a smart question. Yeah, QE is going to come in. I think that is true. That's what's helping equities. Equities will be to the sky if that is. And we're going to see dollar melt if QE actually comes to the table.
Demand for reserve.
Imagine being able to build an app with your name on it just by thinking about it. Meet Base 44.
So that's what I want to pay attention to, because like right after this, I think the markets is going to start pricing in the fact of quantitative easing is going to start soon, right? So if that is the case, we're probably going to see the dollar take a huge dump, and we're going to probably see equities and gold push higher. That's going to be because of the quantitative easing expectations is getting priced in the markets. So that's what I'll focus on.
Will be a topic of committee discussion. Transition to our desired composition will occur gradually and predictably, giving market participants time to adjust and minimizing the risk of market disruption. Consistent with our longstanding guidance, we aim for a portfolio consisting primarily of Treasury securities over the longer run. Some have questioned whether the interest we pay on reserves is costly to taxpayers. In fact, that is not the case. The Fed earns interest income from Treasury securities that back reserves. Most of the time, our interest earnings from Treasury holdings more than cover the interest paid on reserves, generating significant remittances to the Treasury. By law, we remit all profits to the Treasury after covering expenses. And since 2008, even after accounting for the recent period of negative net income, our total remittances to Treasury have totaled more than $900 billion. While our net interest income has temporarily been negative due to the rapid rise in policy rates
everything
to
he has
control
done
inflation,
in the past leading
this
up
is highly
to this
unusual.
moment. So that's what
our
he's
net
just
income
doing.
will soon turn positive again, as it typically has been throughout our history. Of course, having negative net income has no bearing at all on our ability to conduct monetary policy or meet our financial obligations. If our ability to pay interest on reserves and other liabilities were eliminated, the Fed would lose control over rates. The stance of monetary policy would no longer be appropriately calibrated to economic conditions and would push the economy away from our employment and price stability goals. To restore rate control, large sales of securities over a short period of time would be needed to shrink our balance sheet and the quantity of reserves in the system. The volume and speed of these sales could strain Treasury market functioning and compromise financial stability. Market participants would need to absorb the sales of Treasury securities and agency MBS, which would put upward pressure on the entire yield curve,
but he did
borrowing costs
confirm
for the Treasury
the labor
and
markets are
private
weakening.
sector.
So that's one of
Even
the
after
reasons
that
why the
volatile
stock market,
and
NASDAQ
disruptive
US 30
process,
pushed
the banking
higher.
system would be less
But
resilient
it's already
and more
expected,
vulnerable to
but he's just
liquidity
confirming
shocks.
it. So let's
bottom
see if he
line is
gives
our
us
ample
like
reserves
any
regime has
other
proven remarkably
new
effective for
information
implementing monetary
after
policy
he's done
and
with the.
supporting economic
Hopefully he
and
does
financial stability.
a Q&A. If he does a Q&A,
So I will
most
close
likely that
with
will
a
be
brief
an
discussion of the
opportunity
economy
for
and
us
the
to look for a
outlook for
trade.
monetary policy. Although some important government data have been delayed due to the shutdown, we routinely review a wide variety of public and private sector data that have remained available. We also maintain a nationwide network of contacts through the reserve banks who provide valuable insights, which will be summarized in tomorrow's beige book. Based on the data we do
beige
have,
book, so we're going to have to go over that too
the
tomorrow,
outlook for
guys. So
employment and
remember
inflation
that.
does not appear to have changed much since our September meeting 4 weeks ago. Data available prior to the shutdown, however, show that growth in economic activity may be on a somewhat firmer trajectory than expected. While the unemployment rate remained low through August, payroll gains have slowed sharply, likely in part due to a decline in labor force growth due to lower immigration and lower labor force participation. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. While official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue their downward trajectories. Meanwhile, 12-month core PCE inflation was 2.9% in August, up slightly from earlier this year, as rising core goods inflation has outpaced continued disinflation in housing services. Available data and surveys continue to show that goods price increases primarily reflect tariffs rather than broader inflationary pressures. Consistent with these effects, near-term inflation expectations have generally increased this year, while most longer-term expectation measures remain aligned with our 2% goal. Rising downside risks to employment have shifted our assessment of the balance of risks. As a result, we judged it appropriate to take another step toward a more neutral policy stance at our September meeting. There is no risk-free path for policy as we navigate the tension between our employment and inflation goals. This challenge was evident in the dispersion of committee participants' projections at the September meeting. And I'll stress again that these projections should be understood as representing a range of potential outcomes whose probabilities evolve as new information informs our meeting-by-meeting approach to policymaking. We'll set policy based on the evolution of the economic outlook and the balance of risks rather than following a predetermined path. And with that, thank you again for this wonderful award and for inviting me here today. I look forward to our discussion. Thank you.
All right, so far he's dovish, all right? So I would like to see if they talk about like how to shut down, like what is he going to say about the shutdown? Is it impacting their decision? He most likely said it wasn't. So he still sees like a slower growth, slower labor markets is happening. If he continues to stay that path, expect weaker dollar, stronger equities to continue.
Excellent remarks in the Adam Smith address.
And it looks like she's not going to challenge him. She's like a really good friend. So
like a long time.
Should have talked longer.
I won't be surprised that she don't give him no challenging questions.
So let me start with before I go to some of the questions.
And also, this is his last term, so I hope he stirs some shit up. Like I hope he does, but he's very good at what he do.
Again, here that there are no risk-free paths for the Fed now. So in light of that, and in particular with where the recent inflation data are running, let me group this with some of the questions that we're seeing coming in on the app as well. Obviously, always data dependent. But
anybody's in any trades? Anybody took equity buys? I know private members took those gold buys during New York. Anybody in equity buys?
If the rate
or anybody's in any trades
tariffs is slower, that might begin to look like more persistent inflation, as opposed to a one-time, as if the tariff adjustment came through all at once, and then it would be quite clearly a one-time price level shift.
So that's certainly a risk. You know, as I mentioned, there really isn't a risk-free path now, since it appears that inflation is certainly running above our target, and appears to be continuing to increase quite gradually, but increase. It's still on the way up. So there's a risk there that would lend to greater persistence. But
what's up with trades?
now
UJ Sales?
the labor market has
yeah, good job. Yeah,
UJ
UJ Sales, gold buys, gold buys. Yeah, good job, guys.
Payroll
Equity
jobs
buys.
have declined, and
Cool.
both the supply and demand for
good job, yeah.
labor has declined quite sharply. So, you know, those two states of affairs for our two goal variables, call for different monetary policy responses. So, as they come more into balance, I think the idea has been that policy should move from being, you know, tight to some degree to being more neutral as those two things balance out. But it is clear, though, that, you know, if we move too quickly, then we may leave the inflation job unfinished and have to come back later and finish it. If we move too slowly, there may be unnecessary losses, painful losses in the employment market. So we're in the difficult situation of balancing those two things. I think for the last few months, we've been able to maintain a restrictive stance because the labor market was still pretty solid. I think that the data we got right after the July meeting showed that, which adjusted back all the way through May, showed that the labor market has actually softened pretty considerably and puts us in a situation where the two risks are closer to being in balance.
Let's move to the other risk then and talk about employment a little bit. We had Anna Paulson here yesterday, and she spoke about the break-even unemployment.
Finally see gold reacting, dollars pushing lower, yields are still lower.
From the
so
audience as
really
well.
good
So
signs so
she
far.
said that
like equities are already pushed higher. You know,
standard
if he gives us
error around those
something
estimates
extra,
probably
like
include some numbers
a
that might
extra
even be
addition
negative.
for equities to push higher, that's what you'll
Where do
wait
you see
for.
the monthly break-even
But this is good to see
growth
dollar
rates?
weakness.
I'm not going to try to give you a pinpoint number, but as you pointed out, the standard error around these things is, you know, 50,000 plus or minus, something like that. And, you know, that would certainly, I think the range of plausible numbers for the break-even rate is probably does go below zero, accounting for those standard errors. It's clearly come down a great deal. And that's what's so challenging about this is that both supply and demand in the labor market have come down so sharply, so quickly. And the fact that the unemployment rate has barely moved.
Yeah, good job, Nicholas.
Kind
Damn.
of remarkable.
1,000 points.
And suggests that they're moving at roughly the same
give your money back.
pace. Although, of
Will be a good TP if you think. If gold breaks above 4150, I could see it hitting a new high, like range between 4160 to 4180. So I would say between that range, probably 4170 is a good take profit area. It's probably going to push higher. Like we got the pullback consolidation. If we get the breakout, that'd be great. But just remember, like what he's saying so far is nothing new. You get what I mean? So it's just continuations of the overall direction that we're already having.
As we do, are those changing? And in particular, do you think there might be any difference in the impacts of policy on inflation versus employment? Is one changing more than the other?
That's like 2 or 3 questions, so I might have to come back to you. That's right. So on transmission, there, in theory at least, I see 2 things. One is, what we say and the actions that we take on monetary policy and how quickly that gets into financial markets. So if you go back to when I was in college, that part would have taken, weeks, months probably. And now that part happens essentially instantaneously. But the rest of it, once it's in the financial markets, how quickly does it affect economic activity, unemployment, employment, inflation, et cetera? I think that's more dependent on the conditions in the economy. For example, if you take the group of people who had extremely low rate mortgages, right? And even so, if you can cut rates, but they're a long way down, and they're sort of in a place where it's going to be expensive to move and to take out a much higher rate mortgage, even assuming significant numbers of cuts. So that is probably
he's going to be asking questions for the next 30 minutes.
Of lower rates into
hopefully she gives good ones.
But overall, I think it's.
Like I said earlier, what he said so far is it's already been expected, and the reactions we got is already we already have these reactions.
The lore
so let's see if he gives us something surprising where we could actually take advantage of. But so far, I'm still expecting weaker dollar, stronger gold, stronger equities. But it's a possibility if we don't get that we're probably going to see consolidation, because what he says is not going to be the opposite of that. Unless he surprises us.
The research generally shows longer and longer lags for employment and inflation.
Right, and I guess the variable part of that comment does give us a bit of cover.
A lot of uncertainty.
So you spoke about the adjustments or the challenges that you're facing with some government data not currently being published. Beyond the headline unemployment rate, which we're not going to see right away, what other labor market indicators are you monitoring most closely to gauge that side of the mandate?
So I think everyone's looking at the same non-government data. So there's a set of non-government data around, or non-federal government data around labor markets. For example, state level unemployment, claim reports. You can add those up and get a pretty decent estimate, and that's a really good one. There's also ADP has its data in employment. So in the employment space, there's some plausible data. I will say generally the private data, the alternative data that we look at is better used as a supplement for the underlying governmental data, which is the gold standard. And it won't be as effective as the main course as it would have been as a supplement. So we don't expect that we'd be able to replace the data we're not getting.
Everything is already pre-written,
so
it's like they're not going to question. They're not going to
milk pretty good substitutes. Less so in inflation space and in economic activity space. And also, they're just they're different private data providers use different universes and different levels of rigor in their data analysis.
If he says something about how the government shutdown is impacting
we're looking at lots of things, and
then expect reversals.
We're going to make our decisions according to the FOMC schedule. But I think it will be a lot better once we start getting, for example, the September employment report is going to be a very important report, and we're not on track to have that. There would still be time for us to get that. We will get, of course, the September inflation, CPI and PPI reports. So that's a positive. But we don't comment on fiscal matters. But from our standpoint, we'll start to miss that data, and particularly the October data. If this goes on for a while, they won't be collecting it, and it could become more challenging.
You used the term gold
so
standard.
See,
and you didn't
he said
mean
it. So if it's after October, that's when it's going to be
there's
more
a question
challenging.
from the audience that's getting a lot of upvotes. So one of your predecessors, Alan Greenspan, used to view the price of gold as an indicator of inflation risk. So in that context, how do you view the rally that we've seen in gold? And if you want to throw in Bitcoin, you can comment on that too.
Gold and Bitcoin now, guys.
I'm not going to comment on any particular asset price, including that one. And I think we think of inflation as driven by fundamental supply and demand factors, and it's not something we look at actively.
Okay, fair.
See, fair. She don't question him.
The September projections, we saw revised GDP growth projections revised upward for both 2025 and 2026. Now, sometimes it's just an issue-to-issue thing, but how do you reconcile that projection of stronger growth with what we're seeing in terms of a likely weakening labor market?
So even subsequent to the September SEP, we've seen economic
you guys should be in profit.
Activity data, which are
like
surprising.
If
to
you're
the
in
upside.
dollar sells, gold buys, equity buys,
you
should be in
so
really
you do
good
have a bit of a
profits
tension
right now.
there between the labor market data that we see, very low levels of job creation, and yet people are spending. So economic activity is strong, and it's we're going to have to see how that plays out. Right now, of course, we're not getting any new government data on that, any new federal government data on that, but it does create, of course, if economic activity were stronger, then that would tend to support labor market activities and hiring. So we'll have to see how that works out.
All right. Another topic that has permeated the conference over the last 2 days has been AI. So as the Federal Reserve, like all of us, grapple with the implications of generative AI, what plans are in place to assess its long-term impact on productivity, implications for labor markets, and overall economic stability? And does that present any new risks to monetary
so
policy
far
or financial stability?
So you're right.
Gold
We're
buys,
doing what other people are doing, which is
very good profits.
Reading all the things that, so many researchers are working on AI now. It's just amazing. And so we follow all of that. We also have people at the Fed who are doing lots and lots of research on AI. And, in terms of, it's just such early days to be looking for the kind of things that will happen. So, the question of productivity, it was Robert Solow who said that technology is showing up everywhere but in the productivity data. So this could be the same kind of thing where it's there, but it takes a long time kind of to show itself, because you would think of another big technological advance as potential.
Build a website you love with Wix.
Damn ads, man.
For your words?
I think some researchers have found
if you guys
effects
on YouTube,
hiring
I don't think they're
from
gonna
AI for entry-level people
be able to
for
post this
coders
video.
and things like that. So there's probably some of that out there, but it's just so early to say what it will
I think
be.
I'm gonna get hit
Recording
with
in progress.
I think I'm gonna get hit with copyright.
Public companies are saying increasingly.
Just give me a like,
bold
so it's better for the
statements from,
algorithm, so
from
other traders can
big-
find
from
this channel.
large- mainly
Even
large
though if they
private
join, it
companies
might be a
on,
little too late.
things that
But
they
at
think
least,
they can
like
do
right now, guys,
across
just take
their whole
partials,
business
break
area
even if you're in
with
any
AI,
trades.
and either
But this is the
sort of
direction.
freeze hiring
Pretty much
where
what
it is, or
Jerome Powell
reduce
said in the
hiring,
beginning.
and
He was already dovish, giving them
I think
expectations
we're
that he
pretty aware
confirmed the
of what
labor
the
market is
potential
actually
outcomes are, but the
slowing
range
down
of
more,
potential
right?
outcomes
So this is why we got these
broad.
reactions.
I will say, in terms of what the Fed can do,
To do the W's, yeah.
we deal with supply and demand. We have an interest rate, and we also do regulation, that kind of thing. But if what's needed is greater education and skills, I've always liked the model that technology can work for everybody as long as everybody's getting the skills and aptitudes they need to use that technology. This is Golden and Katz, their work, which they actually spoke about at Jackson Hole this year, but it's a 20-year-old book that they wrote. We can't do that. That's not something the Fed can do. We also can't address the potential societal disruptions that could happen, potentially, if there's really significant job loss.
No,
So there are a lot of,
dovish
we're the least of it. There are potentially really significant
direction the
implications
central
for
bank
people in the labor force.
is talking.
And I think
So when we say
we're
dovish,
all
it's usually a weaker
speculating about what those
currency,
might be, but it's
like
only
whatever.
the
Like right now in this
beginning of the
situation, a
story.
weaker dollar and stronger U.S. equity
Looking at
markets.
some of the other questions that are getting
So
upvoted.
weaker dollar, that's EU, GU buys, gold buys,
So,
equities,
let me
NASDAQ,
try
US
this
30,
one.
S&P is pushing
As you
higher.
think of the appropriate level of reserves in the system, what indicators are most important? Is it the price of money, so repo levels, or the volume of borrowings from the Fed, like the discount window, and so on?
So we have a nice spider chart and five main indicators, one of which is sort of repo levels. And I think overall what they're showing is that we're still at ample reserves, abundant reserves. We're still at abundant reserves, meaning above our goal of ample reserves.
So
a little
see,
bit above
repo
ample
levels is
reserves.
one.
But we're beginning to see, you're starting to see a little bit of tightening in money market conditions, particularly repo rates have moved up. And those are the things we're going to be watching. So we think we're still at abundant, and we're, the pace of runoff is now very, very slow. So we're going to be watching all those factors very carefully. And we're not so far away now, but there's a ways to go.
I think we're not going to get away without addressing this one, so I'll try to, again, group some of these together. First, there's definitely appreciation from the audience.
Dan said, he said
your
one,
ability
and then
to
she
try to
kept
remain
going.
above the political fray. And I think also, and as in your remarks, you said gradually and predictably, and that sounds really nice right about now. But with that ongoing scrutiny
But
of
like
policy
he gave it
decisions
away
of the
though,
Fed,
because
what
what he said
measures
was
is
money
the Federal
markets,
Reserve
right? He
taking
sees
and are
little
you taking
tightening. So
to
what he means
ensure
by
and
that
demonstrate
is funding
the
is
continued
getting
independence
harder
in
and more
monetary
expensive,
policy.
right? So the flow of
main
money
thing we
is
can continue
isn't
to do
flowing
is
easily.
to do
So
our
that's
work the
another
way we've
confirm
always
of
done it, which
quantitative
is,
easing most likely
think
is going to
really
happen.
carefully about,
So that's another thing
evolving
that should
economic
support dollar
conditions and the
downside,
evolving
equity
outlook and the
upside.
balance of risks,
So he's literally
and try to make good
confirming
decisions
stimulating
to
the economy.
best
Right, he's
serve
literally
the American
saying
public.
today that
And
the
then
money markets
explain
are
those
tight.
decisions and talk about
So
them in a
that's
way
showing
that makes
stress.
sense
So the next step,
and is
in order
grounded in
to
the
give
data
breathing
and-
room,
and
is
our
cutting
overall
rates
approach.
and putting more
I think
money
we're gonna
into
keep
the
doing
United
that,
States,
and
which is
as long as we're
QE.
doing that,
So he's actually confirming
people
that.
will be able to tell. If we start doing something else, I think people will be able to tell that too. But that's just not something we're ever going to do. We're always going to keep doing our work. We don't engage in back and forth with people.
Yeah,
It's
him
just not-
confirming
that
QE
gets
today
to
is
be
it's more
political
new.
sort of
How
right away. So we just
it's
do
like
our
he's
work
doing it on purpose.
and do it as best
Like
we
he's
can.
it's
I mean,
like he's doing it on
overall,
purpose. He
I
said
would say
it.
the Fed
He's literally
comes
he
through
probably
the
said it
last-
like
if you
3 to
think
4
about it, go
times
back to
already.
the beginning of the
So
global
that's not a
financial crisis. We've
coincidence.
had
I think
two
that's like a hint.
world historical crises back to back.
Gold is already doing what it's
And
been
the
doing
US
so far,
economy,
Jay. So it's
it
already
was
been doing
quite,
it.
It's been quite a ride for the U.S. economy and for American citizens, but we've come through it as well or better than any other country in the world. And we had to innovate and did innovate. There was really no choice. We can look back now and as I did today, and second guess ourselves, which is only appropriate. We've been doing it for 10 years. Since I got to the Fed 12 years ago, we were already doing a lot of that. So that's an ongoing process. But I think if you take a step back, the Fed isn't a government agency that does a good job for the public that it serves. And that is our only goal. And I think we do it pretty well. Don't look for perfection. These are close calls that have to be made in real time. But I guess that's what I would say.
It's fantastic. And in that context, then, internally to the FOMC, how important is it that you have consensus on it? I mean, we're economists. We understand the value of spirited debate, but is that important in terms of communicating the results and the decisions of the committee?
I mean, consensus is great, but I mean, the most important thing of all is to get it right. And that you come to places, not very commonly, but sometimes you come to places where people are going to have different views, and this is one of them. You have a situation here where literally inflation's above target and gently rising. The labor market.
I just
is
don't
subject
like
to
that
pretty
he's still
clear
confirming
downside
higher
risks.
inflation.
What do you do?
So
How
this
do you
is
think about
the
that? That's not a
patient part.
problem that
Like
we-
he's still
that you
saying
face very
tariffs
often in central
is
banking or in the
still
economy.
impacting
people are
higher
going to have
inflation.
different weights and different
So he's
risk
also
aversion and,
making it known that
different risk
inflation
appetites
levels
on
are
those
still high
things. It
too.
would be kind of
So
surprising
this is
if
why
you
like we're
had
not seeing those
no
rapid
debate over
aggressive
those things.
moves,
So we have a healthy
right?
debate going on. I think
Because
it's
he's
very
not
healthy.
saying inflation
I
is
think
lowering.
the meetings that
So far,
we've been
he's
having
still
are
playing
as good
that
as any we've
cautious,
had, in
dovish
terms of people
approach.
sincerely,
But
giving
the
their
tone
absolute
is
best
still
argument for their
suggesting
positions, but
inflation
they're
is still a
different
problem.
positions. That's
Yeah,
I mean,
exactly.
when I
So
was an investor,
CPI next week
I always
is going to
felt
be
like the most dangerous thing
extremely
is if everybody
key
agreed on
for us
something,
to pay
because
attention to.
You need
That's
someone
what's
to
going to
come in
be
and try to explain.
that's what's going to
why
be
this is
really
a terrible
important
idea.
is CPI next week.
Hopefully somebody really
So
smart.
let's
And
see what
then-
happens,
And that would
right?
give you the ability to really test your thinking. So I think that's a healthy discussion that we're having right now. And I'm not at all surprised that we have people across the board. I do think we also, as an institution, do try to come together around a central answer, and that's of course part of what I try to do is
No,
find an
no,
answer
Eric,
that
I think
will
that's
attract
good,
as
man.
much
I'll
support
probably
as
call it
possible.
for the day, dude. Whatever happens after happens.
I know you
You
probably
know, I'll
won't
probably
want
call
to
it.
comment in great detail on
I like the
global
idea
conditions, but
of
there are a few
like
questions
currency dollar
around
pairs
that,
being a better
and what
option
that
to like
implies
hold
for
on to.
US
When it
monetary
comes to
policy,
gold, you know,
and also
chance
just
reversals is
looking at the
always a
interest rate
higher probability,
differentials
you know,
between the
but
US and
dollar,
other
I
advanced
think dollar is a
economies,
good thing to hold on
and
to. Like
how long
if
that
anybody
could
caught
persist,
like
and
US
is
30 and
there a
Nasdaq
risk?
buys, that's probably a good pair to hold
The
on
interest
to.
rate differentials
Gold,
between the
if you
US
got in
and
at gold
other
at like
advanced
4,100, around that
Yeah, I mean,
area, I think that's okay. Like you could
we
let
set
it run,
interest rates
but there's no
according to,
such thing
the-
as like getting
the
out
place
early because
where
you never
our
know.
economy
You know,
is
so
domestically.
profit is profit.
Taking into account.
I'll probably call it for the
the-
day
the,
for you. And
international
just come
aspects
back
of
when
our
there's another
economy.
opportunity, brother.
So again, it's not surprising.
And you got
I mean,
200 pips, so it's
could name
insane.
many factors, but for example, tariffs are clearly more disinflationary for countries that are subjected to them, and they're more.
Like
wouldn't
me,
say
I
heavily
took
inflationary,
partials
but
on gold, and I
there's
have a
some
runner going too.
inflationary pass-through
So
to
if I get
consumers
break even
from
in this runner,
countries that are
like
putting
I don't
tariffs
care.
on. So there's a very different monetary policy response potentially just in that. So, I think we need to set, as every other central bank does, they're setting rates in their, whatever their, remit is geographically, and they're going to be different answers. It's not unusual.
So we have a large number of young economists in the audience today. Could you talk a little bit about,
I
as
know
we look
phase
back
one
and,
was the release of hostages. I don't know what
momentous
phase
awards, a
two
nice
is
time to reflect.
exactly.
If you looked back on your early career and your early goals,
Oh, so I think
how do you
gas will
think
be
that
allowed to
young
enter
Jerome
Gaza.
Powell would
I
view
think
where
that's
Jerome
phase
Powell
two.
is sitting today as the chair of the Federal Reserve?
Surprised. No, I would say, so what I would tell young economists is you've chosen a great profession, a tremendous profession. You're getting the tools to analyze public policy and what works and what doesn't work and what should be expected to work and wouldn't and why. And also what's the state of the economy. And guess what? It's not just hard, it's basically impossible. But it's a very, very difficult thing, but it yields itself up over time. And, it's just an incredibly important subject that carries the capability to do really good things for the general public, who may not feel great gratitude toward economists, but sometimes. But no, it's really important. You've made a great choice, and I would say wish you the best of luck.
So pretty much that's what we are. We're economists,
okay, we'll do a
guys.
little bit-
But we're actually implying that when it comes to trading. So that's the goal. So that's what he's saying. There's college kids there that has a career of being an economist, but that's what we are in the markets. But yeah, I'm done, guys. I took my profits. I'm done for the session. I still even though this is just the 5 minute on gold, but you can see gold is still in the range. Equity's already played out. Dollar is still sitting at that support. I still overall like the downside. I still like weaker dollar, stronger equities, but he's not he's not really saying anything different. It's just confirmation for what we already know is still happening. I wouldn't be surprised though. We see weaker dollar, stronger gold for the remainder of the day. Okay. So if you guys are holding on to your trades, great. So I still think the direction is going to hold, but possible pullbacks is, we can't help that because there's always going to be buying and selling that's going on. All right. So that's really much it. If you guys are interested in a private group, you know, you could just go to the link in my bio or just message me if you just want more information on how the Discord group is. Like, you definitely won't regret it. And yeah, that's it. That's pretty much it. I'm gonna leave it at that. It's 1 o'clock. You can see that she's not really pressure him with questions, right? So it's no point to just listen, but I'm gonna put this live for you guys in a private group. So if you guys want to listen to the live stream, you know, you're gonna be able to do that there. All right. So if you guys want to continue, and then also like the news feed, it's gonna pick up pretty much everything that he says, and like you could just see here, like all the comments that he's gonna say is gonna be here. And then what I'm gonna do later on is all the important stuff, I'm gonna just put it in the market update. So during Asian session, you know, I'm gonna put there what was market moving and what's important moving forward. All right, guys. So that's really it. Like, just be cautious. Do not give your money back, guys. Yeah. Good job, Eric. You're killing it, brother. Good job, man. Yeah, today was a smooth day. Yeah, I'm live on YouTube, Rob. Yeah, today was a smooth day. Like, equity buys in the beginning of the session, you guys took advantage of the gold buys early on in the day. So right now, just chill. Other than that, I think that, yeah, KJ, good buys. Yeah, good job, man. Okay, have a good one. So I think next is just focusing on what, like, so far they really not talking about China. I was expecting Trump to go ape shit on China today, but he really didn't. So either he's a little tired or he's not pissed off yet, but let's see what happens. You know, I still wouldn't underestimate him. Right here, he's focused on Gaza. That's probably what it is. So his comments is more strictly on Gaza. So I think that's going to take majority of his energy right now. But I know that, just be prepared. Maybe Asian session, he's going to probably talk about China, see how that's going to go, because that's also going to impact the markets too on a risk sentiment level. But have a good one, guys. Good job today.